If you want to understand what is truly shifting in the global economic order, you must stop looking at aircraft carriers, missiles, or military exercises around the Taiwan Strait. Military hardware is always deceptive. It can appear dramatically just for an exercise, a diplomatic signal, or a media show. It is the stage of geopolitics designed to be seen. But if you want to know a superpower's real intentions, you must look elsewhere. The movement of sovereign debt. Debt is the foundation of the global system. It cannot move in silence without strategic reason. Restructuring hundreds of billions of dollars in bonds takes a country many months, even years. No one does that on impulse. And here is the fact that cannot be ignored. China held $1.32 trillion in U.S. Treasuries in 2013. By the end of 2025, that figure has fallen to around $770 billion, the lowest level in over 15 years. This is not portfolio rebalancing. This is a deliberate, quiet, consistent withdrawal over more than a decade. When a superpower slowly but steadily exits the world's safest asset, the question is not why are they doing this, but what do they see coming that the rest of the world has not yet realized? And to understand that, you must look at the bigger picture. The picture of an era when the United States and China were so deeply intertwined that they seemed impossible to separate. America is the name economists gave to the gigantic machine that powered the world for over a decade, from 2001 to 2013. But it was never just an academic concept. It was a power reality, an unusually deep fusion between the world's two largest economies. America consumed, China produced, and the dollars generated from every iPhone, every pair of shoes, every container full of goods flowed back to America through a single gateway, U.S. Treasury bonds. That was the closed loop of the globalization era. That was the foundation of American power. And it was also the foundation of China's rise. When Americans swiped their cards to buy, China accumulated reserves. When China exported cheap goods, America kept inflation low. When the PBOC bought U.S. Treasuries, Washington could sustain large deficits without paying the price. The two economies were not merely linked. They fused like two blood vessels in the same body. Looking at the numbers from that period, you see how profound the dependence was. China's foreign exchange reserves surged to $3.99 trillion in 2014, the highest ever recorded by any nation in human history. Beijing's holdings of U.S. Treasury bonds rose steadily from the early 2000s, peaking at $1.32 trillion in November 2013, a colossal figure that only the Federal Reserve itself was big enough to surpass. But the most important thing was not the number. It was the motive. China did not buy U.S. Treasuries because they offered attractive returns. In fact, they offered extremely low yields. Beijing bought for three core reasons. First, to keep the renminbi sufficiently weak to boost exports. Second, to recycle its enormous trade surplus with the United States, sell goods, collect dollars, buy UST, repeat. And third, to have a safe warehouse for foreign exchange reserves. A place deep enough, liquid enough, and large enough to absorb hundreds of billions of dollars each year without distorting the market. Chimereka ran smoothly like a perfect machine, until its engine began to crack. After 2013, the cracks appeared one by one, small at first, but clearer each year. In 2015, China was forced to devalue the renminbi to save growth, a move that shocked the world. Capital flight reached hundreds of billions of dollars, forcing the PBOC to sell U.S. Treasuries to stabilize the currency. For the first time, the role of U.S. Treasuries shifted from strategic asset to emergency rescue tool. In 2018, the U.S.-China trade war erupted. Tariffs fell like sledgehammers. Multinational corporations began leaving China. Beijing realized something it had previously avoided. Washington was willing to weaponize the financial system. From 2020 to 2022, COVID shook global supply chains. What was once considered permanent stability became deadly risk. Both superpowers began strategies of decoupling, but the fatal blow came in 2022. Russia's $300 billion in foreign exchange reserves were frozen overnight. For Beijing, that moment was not news. It was a declaration that every dollar on China's balance sheet could be turned to zero if the United States wanted. And from that point, the withdrawal process accelerated. And the TIC data tells the story. 2013, $1.32 trillion. 2015, $1.24 trillion. 2018, $1.12 trillion. 2022, around $870 billion. 2025, approximately $770 billion. No market shock, just a steady, stable downward slope. This is the reversal flow. No new purchases, no reinvestment of maturing bonds, and deliberate reduction of the dollar share in foreign exchange reserves. The collapse of Chimereka did not happen with a bang. A gigantic architecture began cracking from the inside. And by the time the world noticed, the old foundation was already gone. China's withdrawal from U.S. Treasuries did not begin with a declaration, but with a series of shocks that forced Beijing to rethink the entire foundational question of national financial security. And the first shock was not economic, but geopolitical. In 2018, the U.S. administration imposed tariffs on hundreds of billions of dollars of Chinese goods. It was not just a tariff war. It was the moment Washington proved it was willing to turn economic tools, tariffs, trade, technology, and even finance into weapons to exert pressure. For Beijing, this was the first signal that the system they once viewed as stable and neutral could be used to punish. For the first time in decades, the question arose, could U.S. Treasuries still be relied upon as a long-term strategic asset? But in truth, the crack had appeared earlier. In August 2015, China was forced to devalue the renminbi by nearly 3%, an unexpected shock that rocked global markets. Massive capital flight forced the PBOC to intervene heavily, and the only weapon large enough to stabilize the currency in that panic was U.S. Treasuries. Beijing had to sell Treasuries to buy back RMB. This was not merely a technical move. It was the first time UST were used as a short-term defense tool rather than a long-term strategic asset. That was the first piece of the prolonged sell-off cycle that lasted the next decade. Then came COVID, the greatest stress test of 21st century globalization. Between 2020 and 2021, the United States placed numerous Chinese companies on blacklists, restricted telecommunications equipment, restricted semiconductors, and tightened access to strategic technology. American corporations began relocating supply chains out of China from Vietnam to Mexico. That was a clear signal. Mutual dependence was reversing. What had once been an advantage, tightly integrated supply chains between the two superpowers, now became a risk. Beijing realized that over-reliance on the United States in technology, trade, and finance was systemic risk. A trade war could dismantle the chimerica machine in a few years. So what would happen if a geopolitical crisis erupted? The answer came in 2022, and this was the defining shock. In February that year, Russia invaded Ukraine, and just days later, the United States and Western allies froze $300 billion of Russia's foreign exchange reserves. No warning, no negotiation. Just one decision, and hundreds of billions of dollars became untouchable assets. For Beijing, this event was more seismic than any military exercise off Taiwan. It exposed the true nature of the system. If you fall outside Washington's circle of interests, every dollar-denominated asset can be frozen overnight. From that moment, the conclusion was drawn as a new strategic axiom. U.S. Treasuries are not safe assets. They are assets that can be neutralized. And if a Taiwan scenario becomes a flashpoint, U.S. Treasuries would not just lose value, they would become hostages. But it was not only geopolitical factors driving China's withdrawal. Domestic economics also forced Beijing into restructuring. From 2021 to 2024, the real estate crisis erupted with empires like Evergrande and Country Garden defaulting on hundreds of billions of dollars. Local government debt ballooned uncontrollably. To prevent a cascading credit collapse, China needed domestic liquidity, and that made holding large amounts of long-term U.S. Treasuries irrational. Beijing had to shift strategy from accumulating financial assets to accumulating survival assets: gold, energy, food, strategic metals. This is not a story about yield. This is a story about security. And when the whole picture is strung together, you see that China is not withdrawing because they want war or to overthrow the dollar. They are leaving because the world of 2001-2013, the chimerica era, is dead. What remains is an environment where every economic tool can be weaponized, where finance can be frozen, where supply chains can be reversed, where domestic growth is weakening, and where every nation must look after itself first. Withdrawing from U.S. Treasuries in that context is not a short-term reaction. It is a survival strategy. If a superpower sees the storm before it forms, they move assets before the rest of the world notices the sky darkening. Withdrawing from $1.3 trillion in U.S. Treasuries is not like selling stocks or pulling money from an investment fund. This is the largest and most liquid market in the world, but even that market cannot absorb a national-scale sell-off without causing global tremors. If China dumped U.S. Treasuries en masse, bond prices would plunge, yields would spike, U.S. government borrowing costs would soar, and ironically, China itself would destroy the value of the enormous assets it still holds. A punch at America would simultaneously be a punch at itself, therefore Beijing cannot do it loudly. They can only do it quietly. And the strategy they chose is slow bleed off, an extremely sophisticated asset restructuring technique that most of the public never notices. Its essence is very simple. No new purchases, no reinvestment of maturing bonds, letting the portfolio shrink naturally over time. A steady, non-disruptive withdrawal flow, like letting a giant lake drain gradually through thousands of tiny holes instead of opening the floodgates. At the same time, China gradually shifts from long maturities to short maturities, reducing duration risk, making it easier to exit, and more flexible if liquidity is needed. In addition, a portion of the UST flow is not sold directly in the US market, but is routed through foreign exchange management funds in Hong Kong and Singapore, financial hubs that allow Beijing to maintain strategic ambiguity in public reports. And this is precisely why TAIEC data is so often misunderstood. When reports show UK holdings of US Treasuries surging, or Belgium suddenly rising as a major creditor, it is not actually the UK or Belgium buying to rescue the US market. The UK is the largest custody center for Asian UST, and Belgium is home to Euroclear, the custody system many central banks use to hold US bonds. In other words, China's UST are merely changing storage address, not being bought by European countries on their behalf. This is a natural camouflage layer in the global financial system, and Beijing exploits it to the maximum. When you look at the year-by-year reduction rhythm, you see cold consistency. 2013 was 1.32 trillion, 2018 was 1.12 trillion, 2020 down to 1.06 trillion, 2022 only about 870 billion. By 2025, approximately 770 billion. That is not a chaotic curve. That is a carefully calculated, steady-paced slide, neither too fast to attract attention nor too slow to be seen as inaction. This is exactly the exit profile of a nation that wants to withdraw but does not want to cause disruption. China has also optimized the opacity of the money flow. They avoid any action that could be interpreted as a geopolitical signal. They avoid creating shocks in the UST market because that would boomerang back on their own financial system. And most importantly, they avoid causing abnormal dollar strength, because every time the dollar rises sharply, China's non-dollar reserves are eroded. No strategy could be more perfect for the goal of withdrawing without leaving footprints than the one Beijing is executing. No panic, no sudden pivot. Just a steady, meticulous flow like groundwater eroding the foundation, silent but irreversible. This is one of the most technically sophisticated withdrawals in modern financial history, carried out by a superpower that understands to change the world monetary order. You do not need to smash the system. You only need to withdraw from it long enough, skillfully enough, and discreetly enough that no one notices until it is too late. When a country quietly withdraws from more than $1 trillion in US Treasuries, the most important question is not what are they leaving, but where are they going? And to understand China's strategy, you must look at the map of foreign exchange reserve reallocation happening right now, a map that most of the world will only see when the process is nearly complete. The money leaving US Treasuries does not vanish. It is rematerialized in places that precisely reflect Beijing's fears: financial sanctions, blockade risk, energy security, and resilience against global shocks. The first and clearest destination is gold. For more than 18 consecutive months, according to IMF and World Gold Council data, the PBOC has steadily added gold to its reserves, an historic action, not because gold is the best returning investment, but because gold is the only asset not controlled by SWIFT, not subject to sanctions freeze, with no issuer counterparty, no bankruptcy risk, and no country that can neutralize it with a political decision. In an era where the dollar can be weaponized, gold becomes the final apolitical shield. It also reinforces China's long-term ambition to increase the renminbi's role in global trade through a gold-backed rather than debt-backed foundation. While the West financializes reserves, China is materializing them. But gold is only the first layer. The second layer is energy, the lifeblood of any economy. Beijing understands that every geopolitical crisis begins with energy and ends with energy. That is why China took advantage of Russia's isolation from Western markets to import crude oil at 20–30% discounts. Some is used immediately for domestic needs. The rest is pumped into the Strategic Petroleum Reserve, SPR, that China has quietly expanded for a decade, raising total storage capacity to an estimated over 1.5 billion barrels, far surpassing the US SPR. Beijing is not stockpiling oil to make profit. They are stockpiling to survive if the Malacca Strait is blockaded or if major conflict occurs. Energy is where every crisis becomes real, and China is preparing for the worst-case scenario. The third layer is strategic metals: copper, nickel, cobalt, lithium. If you look at China's real estate sector, you see an industry in crisis. If you look at China's copper imports, you see the opposite. Copper imports remain near record levels. This is not a statistical anomaly. It is a sign of an economy shifting from a cement plus steel model to a clean energy plus high-tech plus defense industry model. Copper is the backbone of electrification. Lithium is the heart of batteries. Cobalt and nickel are the foundation of mobile energy. And all of that is the foundation of drones, electric vehicles, sensor systems, next-generation military equipment. China is cornering the market, securing supply for the entire future production system, not to attack anyone, but to ensure no one can choke them with strategic raw materials. If a nation wants to prepare for conflict or blockade, they cannot rely on open markets. They must rely on their own stockpiles. The fourth layer is food, one of China's most vulnerable assets. The country has only about 7% of the world's arable land, but must feed nearly 20% of the global population. An equation that never balances unless you stockpile. And China has stockpiled. According to the U.S. Department of Agriculture, Beijing now holds 60–70% of the world's total wheat and corn reserves, not because they fear immediate shortage, but because a nation that has experienced historic famine will never again let food security depend on international markets, especially in an age of extreme climate and fractured politics. A food reserve system sufficient to feed the entire country for over a year without imports is not a negative sign. It is a sign that China is preparing for prolonged trade disruptions, natural or man-made. The fifth layer is non-dollar assets. China knows that leaving the dollar cannot happen with slogans alone. It requires an alternative payment system. That is why Beijing began buying bonds in euros, yen, real, and dirham. At the same time, they accelerated bilateral RMB trading networks with Russia, Brazil, Argentina, Pakistan, and even Saudi Arabia, something unimaginable a decade ago. The first oil trades in RMB between China and Saudi Arabia have begun to appear. The renminbi's share in global trade remains small, but it is growing in exactly the same pattern. Slow, steady, non-shocking, identical to the strategy of withdrawing from UST. And when you piece these 5 layers together, gold, energy, strategic metals, food, non-dollar assets, you see a chillingly consistent picture. China is moving assets from the Western financial world to the hard-to-seize physical world, no longer dependent on promises, no longer dependent on trust, no longer dependent on a system where one sanction order can turn $300 billion to zero. This is not a profit-making strategy. This is a survival strategy in an era where money is no longer neutral and trade is no longer apolitical. When you understand where the money is going, you understand what China is preparing for. And that matters far more than how many U.S. Treasuries they have left. The most important thing many people get wrong when looking at China's withdrawal from U.S. Treasuries is that they immediately jump to the extreme conclusion. The dollar is about to collapse. But the truth does not lie in the 2 words collapse. The truth lies in 2 other words: lost monopoly. The U.S. dollar still accounts for about 58% of global foreign exchange reserves, a share no other currency can dream of. But that figure was 73% in 2000. The decline is not happening with a bang, but in quiet shifts, 1 percentage point at a time, year after year, like a dynasty that remains powerful but no longer absolute. And as the dollar gradually loses monopoly, U.S. Treasuries, once the world's neutral asset, begin to take on clear political coloration. Japan, the UK, and some of America's closest allies continue to buy treasuries, but no longer purely for profit or economic stability reasons. They buy because of alliance. They buy because of geopolitics. They buy because they understand that maintaining the U.S. bond market is maintaining the foundation of the order they live in. And when China, the largest buyer outside the G7, leaves the market, the burden of keeping the system running falls on America's own allies. UST are increasingly dependent on the G7, and that is not a sign of strength. That is a sign of a narrowing circle of trust. When foreign demand declines, the unavoidable consequence is higher long-term borrowing costs for the United States. Not because America is weak, but because the market has changed. Countries no longer buy UST with trade surpluses the way China once did. The burden shifts to the Fed and domestic investors. This leads to a clear chain effect: higher long-term interest rates, greater duration risk, and financing the U.S. public debt of $34 trillion becomes more difficult over time. A world in which America must borrow at higher rates is a world where everything from home mortgages to corporate costs is affected. But the picture is not only changing in America, it is changing globally. Parallel to the dollar's slowdown is the rise of a multipolar reserve system. Gold's strong rise from 2023 to 2025 is not because of retail investor FOMO, but because central banks keep buying, with China, India, Turkey, and Russia leading the way. When gold, the oldest asset, becomes the 21st century safe haven for nations, that is a sign of a monetary order changing phases. Not just gold. Oil payments in renminbi, once a hypothesis, are now reality, with the first transactions between China and Saudi Arabia taking place amid Riyadh's reconsideration of the New Era oil strategy. BRICS is expanding, local currency transactions are increasing, and countries like Brazil, Russia, and the UAE are experimenting with bilateral trade models without the dollar. No single currency can replace the dollar. But many currencies together can erode the dollar's irreplaceable status. The future is not the death of the dollar. The future is a multipolar world, where the dollar remains central but is no longer the only sun, where gold, renminbi, euro, dirham, real, and even physical assets share the role once held by a single currency. And when you understand this, you see the clear truth. America is still strong, the dollar still dominates, but the global monetary order has entered a new chapter. This is not the end of the dollar era. This is the end of the dollar monopoly era. When China exits the US Treasury market, the consequences do not stop at geopolitics or national reserves. They reach directly into the wallets of ordinary Americans, into retirement portfolios, into investment funds, and into the foundational structure of the US financial market. And the first challenge is duration risk. A risk most American investors had forgotten after 4 decades of continuously falling interest rates. When foreign investors pull out of US Treasuries, especially long maturities, products like TLT become more fragile than ever. Their value can swing wildly with even small changes in rates, because there are no longer the stable and consistent buyers that China once was. A 1 percentage point rate shock can wipe out tens of percent of long bond value. The market no longer has a steady hand, and when foreign demand falls, only 2 groups are large enough to absorb the massive volume of bonds the US government issues: the Fed and domestic investors. This makes the Federal Reserve the buyer of last resort, even if they never admit it publicly. Dependence on the Fed causes their balance sheet to keep expanding, and the more long-term bonds the Fed holds, the harder it becomes for long-term rates to fall deeply. A financial system where 20-year and 30-year rates are structurally high is not a friendly environment for traditional bond investors. But if you are an investor, this is not the end. This is a signal to change. That change rests on 3 strategic pillars. Pillar 1. Shortened duration. In an era of unpredictable long-term rates, 1 6-month T-bills are a near risk-free haven. They are minimally affected by rate volatility, the Fed, or politics, and they offer yields far higher than in many previous years. Pillar 2. Own real assets. When China abandons financial assets to accumulate physical assets, energy, metals, gold, commodities, they are not doing it out of preference. They are doing it because these are hedges against inflation, financial warfare, and currency depreciation. American investors do not need to copy China, but they need to understand the signal. Owning some real assets is essential. Pillar 3. Watch FX stress. The Japanese yen JPY and British pound GBP are the most important stress gauges for the US bond system. When Japan or the UK, 2 of the largest buyers, face currency crises, they are forced to sell UST to defend their own currencies. Each time they do, the USC bond market shakes. Monitoring USD/JPY and USD/GBP is no longer just FX traders' work. It is an early warning tool for every American investor, and ultimately all of this leads to an unavoidable reality: the end of the traditional 60/40th portfolio. For 4 decades, U.S. bonds played the role of risk-free return, offsetting stock losses, stabilizing portfolios, generating income. But when duration becomes fuel for fire, when the Fed must shoulder the buyer of last resort role, when long-term rates become sensitive to international flows, bonds are no longer a natural haven. The future has no room for the simplicity of 60/40ths. Instead, American investors must shift to a more flexible multi-asset model, a model that recognizes bonds can lose value not only because of economics, but because of geopolitics, that recognizes cross-border flows are the lifeblood of markets, and that recognizes the era when a country could borrow unlimited amounts at low rates is over. This is not a time of panic. This is a time of clarity. Those who understand the change in the U.S. bond market will survive and prosper. Those who still believe everything will go back to the way it was will be the ones who pay the price. China's withdrawal from U.S. Treasuries is not a sudden leap, not a sign of panic, nor a short-term reaction to a single event. It is a quiet process that has lasted more than 10 years. A slow but continuous, steady flow so consistent that most of the world did not notice it was happening until the number had been nearly halved. Only the patience of a superpower restructuring its assets, 1 centimeter at a time. And behind that silence is a strategic message sent directly to Washington. Beijing does not want its financial fate to rest in the hands of a system that America can activate or neutralize with a single political decision. China is not waging war on the dollar, but they will not accept absolute dependence on the dollar. They do not want to repeat Russia's tragedy of 2022. They do not want foreign exchange reserves to become hostages in an escalating geopolitical scenario. They want a safer, more sustainable, less political structure. And that is precisely why the world today is shifting to a new order, not USD versus RMB as many imagine, but a multi-layered system, USD for liquidity, gold for security, physical assets for resilience, and local currencies for bilateral trade. A world where no currency holds monopoly, and where national reserves no longer place all trust in a single system. But the final question is not for Beijing, it is for Americans. Because if China, one of the largest insiders of the system, is leaving in an orderly, slow but unrelenting manner, then Americans must ask themselves, are you sure you are standing in the right place in the biggest financial earthquake of the century? Don't miss the most important analyses of global power shifts. Subscribe today to always stay one step ahead in the most turbulent market period of the century. What you do in these 10 seconds of registration could determine how you survive the next 10 years.